people, welcome back to the Trend Trader channel. Today I want us to look at a couple of things. Basically, I want to discuss the limitations of technical analysis when it comes to stock investing or stock trading. Some of these things that I'll be talking about, it's the things that I've experienced personally in my trading journey. It's not a lot that I want to discuss. So, like myself, I'm a technical analyst, so I'm already aware of these limitations that comes from technical analysis. But for somebody else who might be new to technical analysis, who's probably not aware of these limitations that I'll be discussing today, I think that this video will help you. So one of the first limitation that you should be aware of is that it's possible that you can buy a company that is about to delist. I've done it a number of times, so I know that it's possible. Yeah, so when it happens, you just have to find a way to undo that. Basically, what I'm saying when I say that you can buy a company that is about to delist, since we are focusing on price volume analysis, what you know as price action, you can see that a company is doing good, the share price is rising, it's on an uptrend, and then you buy that company. Then obviously, if it continues with the uptrend, you start to see some paper profits into your trading portfolio or into your trading account. Then one day you receive a communication from your broker telling you that that company that you own is about to delist. So now when that happens, usually when the company delists, they will offer some money to the existing shareholders. There's an option that you can accept the offer, or you can just sell your shares on the market to other shareholders who can make a different decision, or else you can decide to keep your shares, own your shares, but now since the company is no longer listed in the stock exchange, it means that now it's going to be a private company. So for most retail traders holding private companies, it's not an easy task, because there's a lot of things that you need to pay attention to. Even the stocks that are publicly listed, there are some things that you have to keep aware of. But also, at least with the publicly listed companies, you've got more independent analysts covering that stock, and also at the same time there's those if the stock is listed in the Johannesburg Security Exchange, there are some rules that the JSE impose onto some companies. So the companies, for example, they have to report their results twice per year, interim and the final result. If the company does not release the results on time, that can lead to suspension. So now if you find yourself in a position whereby you bought a company that is about to delist, if the company offers you more money than the average price that you paid for that particular company, then you still exit that position with profit, in case you decide to sell it and not hold a private company. So that's one thing that you need to be aware of, because you're not doing the research in the sense that you look at all the company news. You're just focusing on price action, so you miss that announcement maybe that a certain company is about to delist. So for that reason, it's possible that you can buy a company that is about to delist. And then the other limitation number 2, you can buy the same company. By that I mean, we know that there are companies that are listed as holding groups, and some of the subsidiaries of those holding groups are listed as well in the exchange. As an example, Remgro is a holding group, but First Rand Limited is a subsidiary of Remgro. There are many other companies. I think it's Mediclinic. Mediclinic is a subsidiary of Remgro. Another company that is a subsidiary of Remgro is Distel Group. So now, because you're using price volume analysis, you get a buy signal for Remgro. You buy Remgro. In another day, you get a signal for Distel Group. You buy Distel. In another day, you get a signal for F.I.R.E, you buy F.I.R.E. So at the end of the day, you have all these subsidiaries of that holding group. The best case scenario is that each stock you see it as an individual stock or as an individual unit of risk. So if Remgro does well, you make money. If the subsidiaries they make money, you still make money. So that is something that you have to keep in mind. And also note that if one of the subsidiary performs poorly, that might affect the performance of the holding company, because other people they are aware that F.I.R.E is a subsidiary of Remgro. So if, say for example, F.I.R.E is struggling, it does not go up, other people can expect that the performance of F.I.R.E will maybe in future affect the performance of Remgro. Then instead of buying Remgro, they stop buying. That's the better case scenario. They stop buying Remgro, or else they start shorting Remgro. So you will be focusing on all these different companies. So that's another thing that you need to keep in mind, that it's possible to buy one company, because you can buy the holding, the parent company, and then also you can buy the subsidiaries of that particular company. And then the last limitation that I want to touch on is that you can buy a company that does not pay dividends. So we know that a company could be just in the accumulation phase, just trading maybe in a range, bouncing up and down between the support and resistance, and then out of the blue the stock starts to break above the resistance level, and then you can see now the stock is showing some characteristics of an uptrend. Then now the stock catches your attention. Now you're interested in this company because you can see that there's a share price movement. Then you dive in, you buy that particular company. Let's say you buy today, then 3 months later your position is up 30%, 50%, whatever returns that you would have. Then the company release financial statements. Then they say, okay, fine, this company is on a path of recovery, all those good things. Perhaps they have some debts that they are paying, but what they don't have, or what they don't do, the board decide not to declare a dividend because they still want to fix the company financials. So now you find yourself in a position that you have a stock that has appreciated in capital because the value of your investment has increased. But what you're not getting a dividend from that particular company, because the company is still fixing itself. I mean, if a company has been depressed for quite some time, let me use F.I.R.E as an example. For over a year, F.I.R.E has been trading below 5 cents. We know that they have had some several rights offers where existing shareholders were given an opportunity to buy more F.I.R.E shares at a discount. So now F.I.R.E is getting that money. They're using some of that money to pay off some debt, and maybe they're using some of that money to conduct some business. But they're not at a point whereby F.I.R.E can finally say, okay, now we have a business that is profitable, we've got enough cash in their disposal to give some of that cash back to investors. Because for a company to pay dividend, most of the time they will pay a dividend from the cash that they have after they've subtracted all the expenses, and they are still left with some cash. Then they decide to take some of that cash and give it back to the investors or traders. So now if you look at a company that still has challenges, but because there is a bit of a turnaround strategy, in future the company can do better. So people are starting to buy it now, and then the share price continue to go up and up and up. So as the share price go up, the value of your investment, it grows obviously. So you are happy that the value of your investment is growing, except that that particular company at some point it might not pay you a dividend, at least in the mid-term level. Let's say 1 year or 2 years, you might not receive a dividend from that company. So yeah, that's it. Those are the limitations that you need to be aware of if you want to use a technical analysis in stock investment. Remember, here I'm talking about technical analysis where you don't take any fundamental analysis into consideration. We are just trading shares based on their price action. So the three limitations that I spoke of in this video: number one, You can buy a company that is about to delist, then you find yourself in some hot water. The best case scenario is that the company is going to offer you a higher price than the price that you paid for it. Number two, you can buy a company like a holding group that has subsidiaries. So you find yourself in a position whereby you've invested in the holding group and you have also invested in the subsidiaries. And then the last limitation is that you can buy a company that does not pay dividend, despite the fact that your value of your investment is going to increase because of capital appreciation. There are people who invest for dividend income, for example. So if you are one of those people that invest for dividend income, you will be surprised that when you're expecting a dividend, the company executives or the board may decide to say, okay, we are not going to give this spare cash back to the shareholders because we still have a lot of debt or any other things that they think that it would be much better if they use that cash rather than redistributing that cash, redistributing that cash back to the investors. So that's it for today. If you enjoyed this video, I will appreciate it if you can click the like button. If you haven't subscribed, I would like to kindly ask you to please consider subscribing to this YouTube channel. I will see you on the next video.